Good afternoon, everybody. Welcome to this month's webinar, Navigating Tax Incentives and Rebates for Climate and Resilience Projects. Thank you for joining us. I'm Bill Brown. I'm the Assistant Director for Strategy and Engagement at the Indiana University Environmental Resilience Institute, where I lead the Indiana Resilience Funding Hub in collaboration with the Center for Rural Engagement. We help rural communities obtain federal grant funding for their energy and climate resilience projects. This is our 6th webinar. You'll find the recordings for all of the others at our website, and you'll find a link to that in the chat. This webinar is also being recorded and it'll be available to share tomorrow. So we hope you will share that widely with people that you think may be interested. In addition to the webinars, you'll find other resources and a brief start a conversation form. And you can fill that out and you can get direct assistance from our team or simply sign up for our newsletter. Just to give you an overview of the webinar, I will introduce our guest speaker, Doug Baldessari, and he will make a presentation. Then Anna Lim, one of our McKinney Climate Fellows, will moderate questions at the end, and you can drop those questions in the chat during the webinar. So we're very pleased to have as our presenter, Doug Baldessari, who is a CPA and a partner with Baker Tilly. He has over 22 years of experience providing financial studies and municipal advisory services for utility projects. These projects often involve bond financing, financial analysis, and determining utility revenue requirements, cost of service studies, asset management, and financial planning associated with capital acquisition. Doug also has significant experience providing advisory services related to the American Rescue Plan, the Infrastructure Investment and Jobs Act, and now the Inflation Reduction Act, where he serves as the Public Practice Service Lead for Baker Tilly. Welcome, Doug, and take it away.
Great, thank you for that introduction, and I'm happy to be here today to talk about this very important financing incentive packages. I mean, the Inflation Reduction Act that we're going to talk about here today is it's provided the single largest incentive package by the federal government ever for clean energy projects, and you know, these tax credits and grants can be significant for your project, and you know, certainly can reduce the amount of borrowing you need. So you know, as said, I've been a municipal advisor for much of my career, for 22 years, and have since August of 22 been heavily immersed in this Inflation Reduction Act and the tax credits for clean energy projects. Although I started can't believe it's over a year ago since they passed this legislation. We at Baker Tilly have a team of folks in our energy and utilities teams that have been working with these tax credits for over 15 years. Since the tax credits aren't new, the Inflation Reduction Act just enhanced and expanded those tax credits, and as you'll see, made them available for those that don't pay taxes. Here, there's a picture of me. Baker Tilly, we're a large accounting firm. We do audit, tax, and consulting services. And obviously, I'm in the consulting services realm, but we are nationwide. But let's get into the Inflation Reduction Act, which you know, I previewed here in the beginning when we first got on. And this, as I said, was adopted or passed into law back in August 16th of 2022. So it's been over a year. It was a large bill with over 728 pages, had $738 billion of funding available, and $499 billion in new spending and tax cuts. So this is obviously a significant, not as big as the $1 trillion Infrastructure Act, but you know, still at $500 billion, and with its most of its focus on clean energy and reducing the carbon footprint of the United States. This funding is more focused. So what's a breakdown of the 500 billion in new spending? As you can see, the single largest piece of it is these clean electricity tax credits, 33%. And these are estimates. There is no, as the legislation is written today, there is no cap on most of these tax credits. So as you'll see as we get along, if you have a qualifying project, you meet the requirements, you get the tax credits. It's not a competitive type deal for the majority of the tax credits. There are some other healthcare subsidies and such, but we quickly get back to air pollution, infrastructure funding, individual clean energy incentives such as tax credits for electric vehicle purchases, solar panel installations, clean manufacturing tax credits to help manufacturers clean up their act, but help reduce what they're putting into the air. Also, clean fuel vehicle tax credits. There's more funding for rural development for funding electricity projects, and then other climate spending. So, there's lots of money that was given to the DOE for grants and loans. So there really is two main pieces for these clean energy incentives in the IRA. There's the tax credits, and then there are also your more normal competitive grant type, where you would apply for the grants and see if you could get those. So there's both of those two main areas of grant funding. But all in all, about 80% of the overall funding is for clean energy to help reduce the carbon footprint of the United States. So who are the eligible entities, and why, as a governmental entity, would I care about tax credits? The main reason is because the Inflation Reduction Act added a direct payment option for tax-exempt and municipal entities, and even one federal entity. So all of your local governments, not-for-profit corporations, tribes, and others that were previously not able to access these tax credits in the past are now able to do that through the direct pay provision. So that is a huge change. The IRA also added that those, if a for-profit owner wanted to transfer the credits, that there's a transfer option on how you could transfer that to another corporation that may have a large tax liability that they'd like to reduce, or if they have, if they want to add that to their ESG initiatives, to better their company through that manner. So we currently see the tax credits being transferred at about 90 cents on the dollar. So you don't get the full amount, but you could still get a significant amount of those tax credits. And then, of course, a for-profit entity that has tax liability can use the tax credits against their tax liability and reduce the amount of taxes they have to pay. So with these additional ways to access the tax credits, pretty much all of your local government, not-for-profit, manufacturers, individuals, colleges and universities, housing, states, real estate, healthcare, are all able to access these tax credits. So, and as you'll see as we go through here, these tax credits can be a significant portion of your of the project, your clean energy project, and generally we say they can range anywhere from 30 to 50% of the clean energy qualifying costs. So that if you had $1 million of qualifying project, you could get anywhere from $300,000 to $500,000 in a very simple scenario where the entire project qualified. We'll get into this a little more as we go into it, but you know, even for solar projects, there are parts of that project that will not qualify for these tax credits. If you have fencing or other types of improvements that are not integral to the production of the energy, and it gets more complex as you go into the other energy types that we'll go through. So, you know, it is a federal government program. There are requirements as we'll go over, and you know, there may be some costs to be able to go through and get these tax credits, but with the significance of the tax credits, it's likely worth the time and effort. So I wanted to go over, I mean, there is some confusion out there about the 179D tax credits and this tax credit, and then there's production and investment tax credits. So wanted to have this this slide here to clarify things. I mean, the tax credit is a dollar for dollar reduction in the money you owe in taxes, or in a governmental realm, a direct payment of that percentage of your project that qualifies, or from the production over time. The 179D is a tax deduction for efficiency type projects, and that was enhanced in the IRA also. So that's not a dollar for dollar reduction, but it does reduce your taxable income and will lower your tax bill. So it's still worthy, but it is different than the tax credits. You know, taxable entities are eligible for credits and deductions, and so are partnerships, which flow down into the individual partners. So in the Inflation Reduction Act, there are over 70 separate tax credits. You know, there's we're going to go over some of the main energy property types that we're seeing out there, and we're working on a couple hundred of these projects already, and there's certainly more than we're working on. So there's a lot of these projects going on, you know, and there are different tax credits for each energy property, and then each a lot of times in the type of entity that's getting it. And a lot of these, as I said before, most of the tax credits are entitlements. You meet the project criteria. If there's one thing I want you to remember, it's not a competitive thing. These are entitlements, and if you do a project, you meet the requirements, you'll get the direct payment if you're a governmental not-for-profit. This IRA and the tax credits are good through 2032 for most of the energy types. There are some that will be falling off after the end of next year. And so there is time, if you don't have your plan set yet, or if you're not in the middle of a project, to put your plan together and build, do your clean energy project, help the environment, help the community, and then access these tax credits to reduce your local funding portion significantly. This projects are also eligible, even if they began before the act was adopted. If you have a clean energy project that was completed and started producing energy after January 1 of 2023, that is an eligible project for the IRA tax credits. So it is worth looking into. There may be additional reductions based on how it was financed and when it was financed, but it's still found money, and it's still worthwhile to look at. I think, that's the main points I wanted to get across there. So what are the main types of credits that we're seeing out there? The existing credits that were already out there were combined heat and power, which is a more efficient way to use. Most of the time it's gas, natural gas that's fueling the combined heat and power equipment. But instead of just creating electricity and releasing the rest of the greenhouse gases into the environment. It's also producing thermal energy, so it creates both electricity and thermal, and it's a much more efficient way to use natural gas. And we do see this quite a bit, especially like large universities, sewer treatment plants, other hospitals, where they may have a large HVAC or other reasons to have that. Solar was certainly a tax credit that's been out there. Biomass and trash facilities, the burning of biomass and creating and using the energy coming off it to create energy. Biodiesel, carbon capture, where you're capturing the greenhouse gases before they get into the environment and you're storing them somewhere. Renewable fuels, wind certainly is one, and then hydro and geothermal, were all existing before and continue on with the IRA. New credits, there's some new manufacturing credits that we'll go over here in a little bit for production of certain equipment, and to help reduce the greenhouse gases that are being produced. Biogas projects, energy efficient construction is another one for commercial and residential only. There's a solar production tax credit that is also available. Any type of storage, energy storage, thermal storage, that you have qualifies. Clean transportation fuels, electric vehicle infrastructure, charging stations, electric vehicles. And then you have some of the other sustainable aviation fuels, clean hydrogen, zero emission nuclear. So those are some of the new ones. Some of the ones that we're most commonly seeing out there are certainly solar. We see solar on governmental building rooftops, solar adjacent to governmental buildings or sewer treatment plants or water utilities. Solar that will, keep the street lights on. If you have solar on the poles now, you can claim the solar portion. You wouldn't be able to, claim the poles and lights that you would have otherwise had there. But there are lots of applications of solar canopies and parking lots, that you may use that to as electricity in your governmental building, or maybe to charge for charging stations for electric vehicles. There's solar panels that qualify to go on top of roof panels. So we're seeing a lot of solar. We see a lot of biogas at sewer treatment facilities. Most cities and towns, governmental entities have sewage works, and if you're depending on the type of process of your sewer facility and the level of strength that's coming in, you have methane that's produced in the process. To the extent you capture that methane and reuse it to heat your plant or turn into electricity with magnetic power or some other method, those are eligible, and those can turn into quite large tax credits. As a lot of those sewer projects are pretty expensive. Certainly we're seeing some wind, groundwater thermal, to heat and cool buildings, with looping underground. It's a much more efficient way to heat cool your buildings. We're seeing quite a bit of that, depending on where in the country you are. What else are we seeing? Biomass, trash facilities, certainly, and storage, definitely. We even have a clean hydrogen project we're working on. So there's a lot of projects out there, and then there's lots of electric vehicles and charging stations too that qualify depending on where they are. So the IRA does allow for both an investment tax credit, which is a one-time payment or tax credit upon completion of the project. And in the direct pay government world, that would mean the direct payment will come after your project's complete. So there is some interim funding needed there. Or you have the production tax credit, which is based on the actual production of the energy over a 10 or 12-year period after completion of the project. So we think most governmental entities, unless you're a public power utility, will likely, even if you are a public power utility, depending on where you are, but we'll choose the ITC and take that tax credit all at once to reduce the cost of the project instead of taking it over time. But we would normally run both to make sure that we're that the best possible option is available or selected. At least the information's there for government to consider, our clients to consider. And so they're both set up in the same way. Basically, you have a base credit, which is pretty small. In a lot of cases, it's 6% of the qualifying energy property. The most important thing and what the government's wanting to certainly push is prevailing wage and apprenticeship requirements. Assuming you meet those, or you have a smaller project, that's a 5 times multiplier. So that is the largest adder. And then you can get another adder for domestic content. You buy that content US made, basically, or if you're in an energy community, you can get another 10%. And if you're environmental justice, you can get another 10 to 20%, so low income area or tribal area where the project is being built. So that's the difference between those two. If you're here in Section 48, Section 45, Section 48 is the investment tax credit of the law. The production tax credit is Section 45, and then there's a manufacturing tax credit, which is 48C, and then advanced manufacturing production tax credit, which is 45X. So just so you're aware of what those are. If you hear the numbers out there, I'm a numbers guy, I'm a CPA, so we're always talking numbers. So they may not mean much to you, but if you hear them, now you're going to know that advanced manufacturing production is, really for companies that are making solar panels or making any of the equipment that's needed in these clean energy projects. A lot of times will qualify for that. So if you know some manufacturer that's doing something like that, that they can certainly take advantage of these tax credits. I think we went over most of these, but the base, so you can see the difference in the base credit amounts of 6% or 2%, and then also the Section 45, which ones will fall into those. And as I said, a lot of them have both a ITC and a PTC, and it's really just which one's most beneficial to your for your project. So a little bit more about the base plus bonus criteria that the IRA set out and laid out. This is the example of the 6% types tax credit, and you can see the prevailing wage and apprenticeship multiplier gets you to a 30% base. So that is as I spoke about, the single biggest multiplier. And then the domestic content energy community are both 10%. They're actually both 2%. And if you meet prevailing wage and apprenticeship, it goes to 10%. And then the environmental justice for low income areas is 10 to 20%. The only one here that is subject to limitations is the environmental justice. That is requires an application. It's only for solar and wind projects, and there's a limited amount each year. But the rest of the 30 to 50%, when you include the domestic content and the energy community, are all with no limits. And then if you are a tax-exempt entity that issues tax-exempt funding, which comes into play a lot, obviously, with governmental entities, there can be a reduction of 15% of your tax credit if you finance really any but any amount other than a very small amount of your project with tax-exempt funding, you're gonna get a 15% reduction. Now that's not 40% minus 15, it's 40%. If you're eligible for 40%, you multiply it times 15%. So it's only a 6% reduction instead of 40 minus 15, which would be much more difficult. And factoring in the difference in the taxable and tax-exempt interest rates in the market right now, it's depending on the term of your bond, it's usually better to take the hit and issue tax-exempt debt. And there are some reductions for direct pay entities, which are governmental entities, not for profit, if domestic content's not hit in future years, if it's not claimed. So that is something we'll go over here in a little bit. And if you begin construction, IRS has a technical term, begun construction, which becomes important for various reasons. But when they talk about dates, it's when you begin construction on the deadline dates in the IRA. So if you had a project that you had already started last year and you met the begun construction requirements prior to January 29th of 23, and you would automatically grandfathered in to the 30% credit. You wouldn't have to worry about meeting prevailing wage and apprenticeship. And then there's other reasons that we'll go through here as we carry on through. This is just showing that basically the production tax credit is set up with the same methodology, but it's just a price per kilowatt hour that you would receive. Prevailing wage and apprenticeship requirements. I mean, prevailing wage is basically the federal Davis-Bacon wages. Is the federal wages for those who are working on the project. The apprenticeship requirements are brand new with the IRA, and it does require a certain amount of apprentices working on the project based on the number of tradesmen working on the project. So that is something new that has to be met, or at least you have to make a good faith effort to meet it in order to not get some penalties. And there are some stiff penalties for not meeting prevailing wage and apprenticeship requirements. And then as we talked about before, it's a 5 times multiplier. So if you don't meet it, there's a significant reduction. And we talked about the begin construction by January 29. And then an important part is if your project is under 1 megawatt AC, then you do not have to meet the prevailing wage and apprenticeship requirements. So, most of your solar that you're going to put on a rooftop, or even, you're going to put, you're going to use for a municipal building or even a smaller sewage works, is likely going to be less than a megawatt. So in those cases, you don't have to meet the prevailing wage. You just automatically start at 30%, which is great. They did allow for the smaller projects to not have to meet these requirements because they can be very burdensome. So if you have a 1.05 megawatt project, you might want to reduce it a little bit. There's more on the prevailing wage and satisfied if you have to actually meet the prevailing wage requirements. And then you have to maintain and preserve sufficient records. So if your project is over a megawatt, you have to not only make sure you meet them, but you have to have that records retention that proves through weekly pay reports that you are meeting the prevailing wage requirements. And for governmental entities, a lot of you out there, this isn't a new thing. If you go through SRF or RD or other things, you have to meet prevailing wage, and you have to keep track of it. The apprenticeship is what's new, and you have to make sure that you're satisfying that. And again, keep documentation that you have met those apprenticeship requirements for projects that are larger than a megawatt. And that will be important. If I like to say it's like your own taxes. I mean, you file your taxes each year, and you are subject to audit by the IRS. These are no different. these are subject, these tax credits are subject to audit by the IRS in the future. So, you know, I'm not saying that to scare anyone. It's just a reality of the situation that you do want to just make sure you have your documentation in order. Domestic content is a fun one. It's by looking at it initially, you wouldn't think it's that difficult to meet. It is a 10% adder. So there are two components of domestic content. First, all of your structural steel and iron must be 100% produced on U.S. soil. And that's a pass or fail. If you don't meet that one, you don't get it. So if you do meet that one, then you move to the next test, which is a percentage of the remaining equipment and construction costs have to be produced in the United States. So, and those percentages increase over time. So for projects that are begin construction either this year or next or last year, if you already had a project going on, that would be 40% of the balance of the project has to be meet the domestic content requirements, and it goes up to 55% after 26. These requirements are proving to be difficult based on the way the law is written and the requirement and the regulations. It goes down to the manufacturer's cost of goods and profit. So in order to meet the requirements, you have to get the manufacturer's information, not what it costs to who's building the project. It's whoever manufactured the project. So that right there is being in the initial stages here, it's difficult to get that information. And then it can't just be put together. It has to be manufactured here, and we have domestic content experts that assist our clients through that. But basically, there's not a solar panel out there that we're aware of that meets the requirements, because some of the main components are built overseas still. I think that will change over time, but we haven't had any solar projects meet this requirement yet. But some of the other projects I think are more likely to be able to meet it. The difficulty then becomes getting the information to do the calculation. And we think we have a way to do that where, you know, we would serve as an intermediary, independent reviewer that through a non-disclosure agreement wouldn't give it to the ultimate owner, but would prove out that it meets the domestic content requirements. And then there's additional reductions in the credit. Now again, this doesn't apply to smaller projects. So if you're under 1 megawatt in production, these don't apply, but any of the larger projects it does, and it's only for direct pay recipients. I don't know why they didn't include all the other normal ones, tax credit filers, but after January 1, 2024, which is coming up here in a month, if you have a project that begins after January 1, 2024, not one that began this year or last year and is still going on, if you don't meet the domestic content requirements, not only do you not get the 10% adder, but you will get another 10% reduction in your overall credit. And then for projects that begin after in 2025, it's a 15% reduction if you don't meet domestic content requirements. And then for large projects after December 31st of 2025 that begin after that date, there will be no tax credits if you don't meet the domestic content. So the law is really pushing meeting these domestic content requirements. So I do think that, you know, they're trying to bring more onshore manufacturing of these components and equipment. And so we'll see how this works out over time. But again, this does not apply if for smaller projects. Begun construction. We talk a lot about this, and you know, this is an IRS defined term. So if you begin work of significant nature, so you don't want to get the 10% reduction. You know you're not going to meet domestic content on your project. You want to begin construction by the end of this year if you can, the next month. May or not be possible, may or may not, depending on where you are in your project, but there are two ways to meet it. You can either start physical work of a significant nature, actual work on site or off site. If you have a big piece of equipment that has to be manufactured off site, that can also count. Or incur 5% or more of the total cost of the facility. 5% safe harbor is what they call that. Those, again, there are certain requirements to go along with those, but there's good reasons to meet those begin construction requirements if you can. What doesn't qualify for physical work activities? Planning, design, permitting, studies, financing, surveying, site clearing are some of the main ones. If your actual physical work needs to be actual construction or manufacturing of something, a piece of equipment that you need. The 5% safe harbor does include all costs, including engineering. You don't have to do any physical construction. So there's two ways to meet it, one or the other. It depends on your project, which one would fit the best. Regarding energy community, they were wanting to, reward, areas of the country that are relying on coal or oil in their economies with this energy community energy property adder, 10% adder, 2 to 10%. So really, it's basically where your project's located and if you qualify. So we do have a mapping tool. There's also one Department of Energy that you can look up and see if you're planning a project in a certain place, if that project will qualify for this 10% adder. There's really three ways to meet that 10%. You can either be on a brownfield site, you can be a metropolitan statistical area that meets the director employment requirement or tax revenue requirement, regarding coal, oil, natural gas. Or the easiest one is if you're not easy, if you don't meet it, but it's easy to see if you actually meet it or not. If your census tract or the adjoining census tract had a coal mine closed down since 1999, or had a coal-fired electric generation plant that's been retired. So those are those ways. Again, we have 2% or 10% because that's where the prevailing wage plays into this. The environmental justice, wind capacity bonus, solar and wind. Again, this is a bonus. These are limited. You'll see here in a second. There are certain qualifications. It has only a solar or wind. The maximum net output has to be less than 5 megawatts. They don't want large projects in here. We're going after these. And, the project has to be located in either in a low-income community or an Indian land, or part of a low-income residential building project. So these credit increases can be anywhere from 10 to 20%. So they can be quite large. Here's some information regarding those low-income benefit projects. If you have a residential building project that meets it, or a low-income economic benefit for this adder. Here are your limits for the current year. There's 1,800 megawatts available. A 10% adder for low-income community or an Indian land, and then your residential building projects or low-income economic benefit areas are 20% each. So there's projects in various stages. There are projects that were started, qualifying project, clean energy projects that started before the beginning of this year. So if you had one of those and it didn't complete until this year, you probably want to relook at your project and see if you can access these tax credits if they're available for your project. If you had a project that was already planned and designed and you're ready to move forward and you hadn't contemplated the tax credits, well, you probably want to take a minute to look into that. And then certainly if you're planning projects in the future, you want to include the IRA provisions and benefits that may be out there. So, a good idea, and what we're helping most of our clients with is a high-level planning study to give boards and stakeholders comfort that there's no application. The IRS is not going to say, yes, we agree that you're going to get $500,000 for your project. So these high-level planning studies give first an estimate of what you're going to get in the tax credit, and then comfort that you will get that because your project is eligible. And then we obviously can get more detailed in that modeling. From a financing timeline standpoint, there is as I spoke about before, these are more rebates or reimbursements of costs. You will not get your direct payment if you're a governmental entity of the tax credits until after the project is completed. So, and it really depends on your tax year. So if you're a calendar year, which I think we have a lot of Indiana communities on here, which we are here in Indiana, and you finish your project in January, well, you're going to have to wait until after the end of that year to file your tax form. And then it could be, 6 months or so, and before you actually get your payment. So it can be anywhere from 6 to 18 months after your project's placed in service that you get your money. So you do have to find interim funding, whether it's through a short-term loan or you have cash on hand that you can use to pay for the project, and then you get reimbursed later. These tax credits can be combined with other federal grants. So if you have ARP monies you want to apply, if you have other federal grant funding that you got for your project, it's a qualifying project, you can also get the tax credits, which is different than some of the other federal legislation on grants. Here you can combine the two. The only requirement is you can't combine the tax credits and the grant money and get money paid back to you over and above the cost of the project. So you can't make money on your projects, but you can certainly fund the full amount with tax credits and grants. So let's see. So we don't have yet the full regulations on how the direct payment will work. There has been interim guidance out, that there is going to be a registration process. You're going to have to register your project, and then you get a registration number, and then within 4.5 months after the end of your tax year, which if your calendar year would be May 15th, you would file your actual tax form to get your direct payment. And there are 6-month extensions available without a problem. So, we have that information, but we don't have yet from the federal government how the direct payment will fully work. We are expecting that at any point since we are almost in December, but we have not received that yet. And then if you do claim excessive credits, there can be penalties. The same way as there's significant penalties for not meeting prevailing wage and apprenticeship. So obviously you want to be righteous in what you're filing. But we do expect this information to come out any day. So hopefully they will. And along with, we did receive guidance in the last week and a half regarding eligible property. And this is more to go back to the complexities of the tax credits, where I talked about solar and the fencing not, being allowed as a property basis to apply the tax credit to. It gets more complex with combined heat and power, groundwater thermal heating and cooling and storage. It's only the eligible energy property, and this new guidance that came out was somewhat restrictive, but still, there are significant dollars out there for these tax credits that you can get on your project. So with that, that is the end of my presentation. I think I'm right about 1:45. So I don't know if there's any questions out there. Or...
Yes. Hi. So as I'm looking in the chat, one of our questions for you, is about, filing the tax filing process. Someone has asked, is it something that they should seek out support for filing, or is the procedure simple enough to do individually?
I think that's going to depend on the the capabilities of whoever the entity is. If they're used to filing tax forms, if they have the capabilities to do it in-house. Certainly, people file their own taxes all the time, so that could be done. But I think making sure you have the right amount and that you met all the requirements, probably, in my view, would take some assistance. But it really depends on the capabilities of the tax filer.
Fantastic. Thank you so much for that. Another question is, how far back on projects can people go to claim benefits? Like, do you have, like, for example, a year number off the top of your head?
Well, there really isn't. It really depends on when the project was finished. So, if you had a project, say it's a big project, big biogas project at your sewer treatment plant, it took 3 years to build. It was completed and started producing energy in February of this year. Well, you can go back 3 years and claim that project. So it really, as long as the project is completed in 2023 after January 1st, that project would be eligible no matter how far back.
Awesome. So let me see. We've gotten a lot of more questions in the chat. Someone else has asked, um, uh, can you begin claiming credit on works in progress or projects in progress?
That yes,
Mhm.
it has to be a very long project and a large project. So if the project, if it takes not engineering planning the time to plan it, but if the actual construction of the project takes more than 3 years, then you can file interim tax to get interim direct payments of your tax credits on an annual basis.
Thank you. Um, let's see here. Another one is, um, are there any specific criteria or qualifications that individuals must meet in order to be eligible for the full value of tax credits for, say, installation of solar panels on a private home?
Hmm. I'm not up on the private home stuff. I've been just working with public entities, so I'm sorry I can't answer that, but we could get the information for them.
Okay. Okay. Um, uh, also, is there any particular documentation or reporting obligations that an individual should be aware of to ensure a smooth process in accessing these incentives?
Absolutely, absolutely. You have to, even if you have a smaller project, you're going to want to make sure you have the documentation, proper documentation that proves that your final costs and those final costs, all of them were eligible for the tax credits, and that you're calculating the proper amount. Now, if you have a project that's over 1 megawatt, then you definitely want to have weekly payroll records, weekly apprenticeship records, um, um, you know, all the documentation and if you're meeting begun construction, you want to make sure you have documentation related to that proves that, you know, in the end, you want to have all the documentation available that if the IRS comes 4 years or 5 years from now and says, show me your file, that you can substantiate the amount that you're claiming as a tax credit.
Yeah. Okay, so maybe just a couple more questions. And hopefully we'll be able to wrap up by 2. But so another one is for projects potentially under 1 megawatt, would they be able to meet the apprenticeship requirements to get the 10% bonus, or?
The apprenticeship is the 5 times multiplier to get you to 30%. But yeah, if you're under a megawatt, you automatically get that. You don't have to meet them, so you wouldn't even have to pay prevailing wage. You're automatically get the 30%. So it's just a matter of whether you get the 10% domestic content or the 10% energy community on top of it. So, so that's a good fact pattern if you're less than a megawatt.
Okay, fantastic. Now, just like 2 more direct pay questions. One is for so this person was like, I was paying attention, solar and battery. I heard that solar and batteries can receive credit, but do you know if geothermal heat pumps would also be able to be eligible for credit?
Definitely, yes. In fact, we're working on many geothermal groundwater thermal where they put the ambient loop underground and use equipment for heating and cooling of governmental buildings. Those are absolutely eligible.
Okay, fantastic. And the last one is, what is the best way to ensure that we are notified when more information on direct pay is released?
Well, I'm sure we'll put a blast out when that comes out. You know, keeping up on the regulations as they come out. I'm sure there's you can go to the Treasury's website and sign up for notifications when they come out, or you can count on your consultants to provide that information, or maybe even ERI would provide it once they heard it.
Right. Yeah. Well, thank you for sharing. Now I don't think I'm seeing any last questions in the chat. I guess I want to thank you again for your time, and if you have any last words for us, uh either you or Bill, I'd be happy to hear you say what you have to say to close out the webinar.
Yeah,
Thank you
thank you
again.
very much, Anna. Really appreciate your help. And Doug, wonderful presentation. And just as a reminder, this webinar will be recorded and you'll be able to access that. If you have additional questions, please use our contact form, which again was in the chat. And if you can't find that, just email us at ERI and we'll answer your questions as best we can or point you to somebody who can. The other thing that we wanted to remind everybody that the Indiana Sustainability and Resilience Conference will be held February 9th at IUPUI Campus Center. We have a keynote by Michelle Moore, who is the author of Rural Renaissance, Revitalizing America's Hometowns Through Clean Power. So we hope we'll see you at that event. And again, there should be a link in the chat. If not, go to our website and you can find more information about the Indiana Sustainability and Resilience Conference. Again, thank you all for being here. Thank you, Doug, Anna, Jonathan, Genevieve, the whole team, and hope you have a great afternoon. Thanks for coming. Bye-bye.